Maybe one day we'll be good at this.
I was like, there are people taking this thing seriously enough to build hardware? This is crazy. My mom always used to say capitalism is just bundling and then unbundling the same thing and then bundling back up together most of the time. And I think she was probably right.
Welcome to the Coinbase Developer Podcast, a technical deep dive with top on-chain builders in crypto and beyond. I'm Yuga Kohler, engineering lead at Coinbase Developer Platform.
And I'm Erik Ruppel, head of engineering at CDP.
So Erik, we're sticking with a theme we started with a previous episode of the season by interviewing David Hoffman, host of the Bankless podcast.
Yeah, continuing our streak of podcasters and interviewing podcasters. Maybe one day we'll be good at this, but today's probably not that day, given how much I've bumbled through this intro.
Well, this is our opportunity to get better. Our guest today is Tarun Chitra, the CEO and co-founder of Gauntlet, which is a DeFi company that provides yield-optimizing vaults at institutional scale, as well as applied research that helps protocols like Uniswap and beyond. Tarun is also a partner at Robot Ventures and a co-host of The Chopping Block, which is something I listen to a lot, one of crypto's sharpest podcasts. He brings this unique blend of quant finance, research, and on-chain experience, which makes him a perfect guest for us. So Tarun, welcome.
Excited to be here. Thanks for having me.
So one of the things I find very cool about your background is you're very math and quant heavy. You studied a lot of that in college, and you really started in TradFi. You were working at Vatic, as well as DE Shaw, which is like one of these firms that is coated in mystery and is like very secretive. Would love to hear a little bit about like your early work in the intersection of math and finance.
Yeah, for sure. So actually, I first worked, basically I was going to go do a math PhD, and then I got this job at DE Shaw that was like, hey, before you take a 2-year sabbatical from going to grad school and come work here. And basically I was like, I think like I forgot what it was like exactly the decision day or intro day or something, like when I went to grad school, and I was like, wow, everyone here is like not sure why they're here, and I'm like even more not sure why I'm here, so maybe I should just go do this 2-year thing, and then if I hate that, then go back, right? Like somehow the first day just gave me this like, I'm gonna regret not trying something else first because I can go back to this. And so then I took that, and then I never went back. So maybe that was depending on whether you view that as luck or not. I actually worked on building hardware, on building ASICs for the first 6 years, and simulations of different types of systems, some backtesting, some sort of like more scientific simulation systems in custom hardware. And that's sort of actually kind of how I got into crypto. So, when I was working on ASICs, building application-specific integrated circuits as sort of like custom hardware, at that time in 2012, there wasn't really a lot of demand for people doing ASICs. At that time, I think people were still on the mindset of like general purpose computers and general purpose hardware are just going to keep having Moore's law. I think at that time people were starting to be like, this can't last forever. But there was definitely still this feeling of like, hey, we've had 20 years of like every 18 months Intel pumps out a new faster processor. So at that time there was no competition for ASICs. Like there was no AI chips. The LiDAR stuff for self-driving cars just started. So there wasn't really much. And the reason I bring that up is in 2012, basically we had this chip order from DE Shaw that was like $20 or $25 million of escrow that we had to pay. And it's a little bit like block space. Like every fab has like a certain amount of chips they can make per day, per week, whatever. And you're reserving space. Like you're literally reserving some fixed amount of their production. And so we give that and to do that, you have to like give them basically upfront escrow payment. And the supplier just ghosted us for 6 months. Basically, like, came back 6 months later and was like, we'll give you a 10% discount. And obviously, when you give someone $25 million and then they ghost you for 6 months, you're like, what the fuck happened here, guys? Like, what is going on? And it turned out it was like one of the early ASIC mining, Bitcoin ASIC mining people who had like paid them to front run us. It was like literal kind of like physical MEV, I guess. You know, like.
Would you say this was the original bid for block space? Is bid for ASIC manufacturing space?
It was very competitive back then because like another maybe nuanced detail that maybe too in the weeds, but like is kind of fun to think about because like it's not true anymore. Is like back then there was just so few people building custom hardware that the only people building custom hardware were like NVIDIA, Samsung, Apple. And so all of those three had contracts where they were like bidding with TSMC for like billions of dollars. And so TSMC at that time would be like, you have $100 million chip order, I'm not talking to you. And so there was this whole supply chain of aggregators who would like aggregate people's like 10 to $100 million orders until they added up to like a billion or whatever the minimum TSMC had, such that they could like operate the factory profitably. So basically the thing is the aggregator is not actually the fab. So it was a little bit like this MEV bidding stuff. It's like the searcher, the solver is this person aggregating the block and submitting the bid. And the searcher was bribed by someone else to like put some other transactions in front of us. Basically.
And so,
and
when D. Shah was like trying to get these ASICs, was that like for the purpose of Bitcoin mining or some other HFT purpose, or were they just speculating on ASICs?
No, so I initially worked at this part of D. Shah, which I would kind of call a charity is the wrong word. Basically, they were spending money doing physics research. So we built ASICs for doing like physics research. In fact, my first boss there went to go run all the kind of protein folding stuff at DeepMind and won the Nobel Prize like last year, 2 years ago. And so it was actually like for like a pure science thing, but the hedge fund was funding it. So it was sort of like a very weird, but that was sort of why I was convinced to go from grad school. Cause I was like, I don't know if I'm totally ready to go trading, but then later I went into the trading side. So, and there we just use FPGAs. So no custom hardware, but like off the shelf, but programmable hardware. Yeah. Sorry,
no, please
I
go
could
for
find an FPGA if you want, but field programmable gate array. But yeah.
No, I was gonna make an observation, which I think, tell me how off I am, which is the world of high frequency trading is actually incredibly similar to the world of Bitcoin mining, because you're basically both just doing a computation, and first to achieve the result gets a bunch of money. And so you have these companies spending they're all running functionally the same algorithms at HFT is my understanding. And it's really like a who can do it the quickest competition.
Yeah, I think that's definitely certainly true right now. I think in 2012 through 2016, so like basically 2008 to 2012, I would say like it was brains over speed. Like you didn't have to actually be straight up the fastest to win. You could actually have smarter algorithms. But by 2012, basically like the financial crisis created all of these like opportunities that a lot of HFT players grew really big on. And then in 2012, a lot of the employees, or like 2010 to 2012, a lot of the employees at these places left to start their own things. And I think what happened was that just like made it such that being a smarter algorithm didn't help you as much as just like access to like being fast, because there was like a ton, there's almost this like disaggregation thing. Like you took all these people who were working together and like they were competing against each other less, and then you split them up to compete against each other, and then the only advantage became speed. And it was like kind of brutal, like that era, the 2012 to 2016, where it was like stuff like how much better your hardware was determined things. And basically what happened is the same thing that happened in sort of multi-strategy hedge funds, which had kind of like contracted to like a small number of players, and everyone who was an upstart or startup just ended up shutting down or joining one of the big funds, because the capital costs of getting into the speed game were too hard. This is the same thing that happened with Bitcoin miners, except it happened with them much faster. It happened like 3 years, right? Where there was like a ton of small players, and they all kind of, Bitmain kind of aggregated a bunch of them, and then like it was impossible to kind of compete.
It's really interesting to. I'll let you like push on in a moment. You guys, sorry for interrupting. I think it's really interesting that the exact same thing is happening in AI right now as well, where you had like a conglomeration of like all the researchers at Google, and then they all kind of spread out, and now they're kind of all getting like picked up and rolled together again. And so it's interesting if that's like just a thing that happens always, or if you can actually have like a fractured ecosystem like that remains healthy.
My mom always used to say capitalism is just bundling and then unbundling the same thing and then bundling back up together most of the time. And I think she was probably right about that. Although I think the AI researchers are getting a much higher percentage of profit than than I think the trading people did, because in trading you had to be profitable, whereas in AI I feel like there's always one more of a VC somewhere around to finance buying an expensive researcher. But yeah, no, this type of stuff happens. Like, I feel like every technology push always has this. So this wasn't really an answer to your question about the finance side, but it was actually, that was sort of how I got into crypto, was like that front run thing was like, I was like, there are people taking this thing seriously enough to build hardware. This is crazy. And I mined a bunch of Bitcoin on GPUs because it was still possible in 2013, barely. And then was an idiot and sold it all. But I feel like everyone has some bad trade lesson. But then I just kind of kept paying attention, and then so at Deja, after when I kind of was more on the finance side, that was more like mid frequency. So like a lot of the big startup funds don't do high frequency stuff, and that was very good for like learning financial math. That was like kind of where I learned a lot of the basic financial math stuff. But then I went to a small high-frequency trading shop that was a startup, which is one of this example of like people spinning out their own. That was like the era when everyone was doing that. And I think at that time, actually, almost like similar to now, everyone was like, oh, the reason I'm going to leave and be able to beat my old employer is like AI is going to help me. Like, it's actually kind of funny because like people were still doing the whole like AI HFT thing then. And like it's still, for the most part, hasn't like... I think like if there's any company that's successful, it's Hudson River Trading. I don't think anyone else is like actually doing like large capacity models. Everyone's doing kind of simple models still. And then when I was in HFT, I worked on like back testing and simulation. So like, modeling our strategy and like what signals it's sending fills on, and then trying to make sure like our simulation was like matching like the real fills as closely as possible. So like looking at how fast the hardware was firing, and then using that as like a signal in like a machine learning strategy to adapt. Hey, the latency we're getting for this particular type of order is like 99th percentile. Okay, like that strategy needs to change in response to that, stuff like that. But the interesting thing about HFT, by that time, it got so competitive that you spent a lot of time building simulations that were like multi-agent simulation. So like in 2025, you say that everyone knows what that means. But in 2016, if you said that, like it was not a very like well-known phrase. But what you do is you would model your strategy and then someone else's, and then and whoever else you thought was in the market, and like run many simulations of those to get some idea of like, hey, this is the type of user that my strategy is like beating, or this is the type of user who causes me a loss, right? It lets you get some attribution. And at that time, was around the time I think like the Algorand white paper came out, was like 2016. And the interesting thing about the Algorand white paper was like it was extraordinarily rigorous on like the cryptography side and extraordinarily rigorous on the distributed system side, but it was insanely unrigorous on the economic side. Like at that time, all these proof of stake L1s were kind of like, that was the era of like the L1 white paper, like before the Gnosis ICO, so like before November 2016 or something. And so like they were all really interesting because like they were so rigorous in some directions and like had zero rigor in the other directions. A lot of them were just like, we're just going to copy Ethereum's inflation curve, or we're just going to copy Bitcoin's inflation curve. But somehow to me, something didn't sit right about it for two reasons. One was, if you're telling me your network is going to have 100 times the supply, like higher throughput or higher bandwidth, how can you have the same economics as something very slow, right? Like the model of like induced demand has to be different if I have a higher throughput blockchain, and like that is what we see in practice now, right? The differences between Solana and Ethereum and stuff like that. But at that time, I think it was like these things were all hypothetical, right? There was like they didn't exist, so people were like not really thinking about that. But because I was in trading, I was like, proof of stake is actually sort of like a weird derivative asset, because part of the supply is like locked in the network when you're staking, and there's part of the supply that's liquid elsewhere. But how much you trade the liquid supply changes the underlying locked asset value, which is sort of the opposite of proof of work, right? In proof of work, the locked assets are like the electricity that you're locking up, or like your electricity contracts, like what you've paid the data centers. And the Bitcoin price changes how well you can pay that, but it doesn't change the value of the hardware you bought or the energy you paid for, right? And proof of stake is the opposite, where it's like every trade of the asset changes the underlying thing that you have to stake, right? The computers in proof of stake are much less costly than the actual stake itself, right? So the value is much lower. So anyway, this is a very long story into like went down this rabbit hole of like how do you analyze these things, because like they feel like some weird financial derivative in a way that like proof of work wasn't. So then that kind of got me down the rabbit hole.
And so that kind of takes you to Gauntlet, which, as you mentioned, does these sort of multi-agent simulations, especially at a time where like these DeFi protocols are coming online. And I would assume like, when you're coming from a world of even mid-frequency, right? Not necessarily HFT, but like, back then Ethereum block times were, I don't even know what they were, like 30 seconds, something like that. Like how much, like, was it like, were you doing a bunch of MEV back then through Gauntlet? Was it like, did you have a significant advantage having all that knowledge that you built up from like the centralized trading world and TradFi and applying it? Or was it like there were other sort of curveballs that you had to figure out?
Yeah, so I mean, I think I had kind of focused more on the like risk and like understanding side than the like trading side, partially because one thing I had observed about TradFi is that a lot of so like HFT firms generally, for the most part, don't have a long like lifetime. And part of the reason for that is they're usually hard to adapt to new strategies, and or they're like taking risk in markets that for a little while, like there's no risk in that market, and then all of a sudden there's a ton of risk, which to crypto people you're very used to that, right? Like yield farming markets are exactly like this. And look at the Plasma launch, like the amount of capital that went in there expecting a return, and then very quickly, like last Friday happened, the October 10th crash. And like all of a sudden that thing was like a huge underwater farm and everyone's exiting at the same time. HFT has this like longevity problem. And I think because I was at a place that was like a startup that came out of a big place, I like even saw that even more directly. And the thing about somewhere like D.E. Shaw is like they spent a long time building like risk models and quantitative models before they really started becoming big at doing trading at size. And I sort of felt like a lot of stuff in crypto was focused on like the short term thing versus like the long term thing of like make the systems resilient, understand the risk, and then kind of start figuring out that. So at that time it was like really more just focused on like what is the math for these things, because the math has to be different. Like I think pre Compound and Dharma, if as a throwback, if you remember the one of the old lending protocols, like pre them launching and I guess pre Maker, there was kind of this idea that like, oh, everything in crypto is just like TradFi but with shitty assets or something. Like the 2017 token boom, I feel like was like that was like sort of the sales pitch I feel like people made. While that's true, there's a lot of fundamental differences in DeFi protocols, because like, in a centralized exchange, like if I'm on the CME and I get liquidated, the exchange is liquidating me. So it's like there's only one agent I have to model, which is the exchange who's quoting and exchange who's liquidating me. But in DeFi, I have to model the protocol, I have to model the oracle, I have to model the liquidators, I have to model all these things. Like it like unbundles a lot of things in traditional finance that are all the same entity. And oftentimes it's much easier to model these things as the same entity. And, you know, obviously there's some people who try to force that, like FTX, but like, you know, that didn't work. But like the unbundling means you actually do have to like study these idiosyncrasies. And I think I always just felt like, hey, people need to like actually be able to do that in a confident manner first. And I think it's just things like that just take longer to mature, and I think that's why DeFi in general has like kind of, it's taken like 5+ years, even though like I wouldn't say the mechanisms have changed that much. It's like people's understanding of the reliability of all the components and all the different agents and all the different how the networks interact with one another. That stuff you have to kind of like learn empirically also, right? Like, and so I think that's even why, you know, as an example of like longevity, I think if you look at the Ethereum block builder space, there's been very little longevity there. Like there was a ton of rotation of different parties. Like it initially was, you know, 2 parties who dominated everything. Then one of them fell out, and then a new party came in, and then now it's sort of like 4 people kind of competing for similar market share. I think this gets back to this HFT thing of like these strategies that rely on these like extremely these things that are pure competition where there's like no long-term edge just like degrade into these like foot races, whereas these things that you have to spend a lot of time understanding the risks carefully, but you know eventually you can convert those have like some like lasting power. And that was like a lesson from finance I think I got, which I think you know is not so obvious, I guess. Like it wasn't obvious to me, at least, for sure.
So would it be correct to say, like, you know, you talked about how you model these multi-agent systems and in DeFi there are these various parties like the Oracle, there are the liquidator bots, there are the arbitrageurs. Like, has like Gauntlet's underlying model for this remained consistent over the years, where like you're obviously iterating on the model, but like there's not necessarily been like a wholesale change of the architecture? Or have there been like step up moments, just like, you know, in AI there were like transformers and so forth, where like the fundamental way that you model them has changed?
Yeah, so that's a good question. So I think from 2018 to 2021 there were a lot of changes because there were like a lot of new protocols, right? Like people trying a different liquidity model, different AMM curves, different whatever, right? And then I feel like 2022 to 2023 there was like a lull, or kind of like, you know, realistically there weren't new protocols. Some of that I attribute to fear. Like people saw Luna and then were like, okay, well DeFi's dead, right? Like there were so many people who I feel like after Luna were like, oh, it's all dead. Because like the only thing they ever knew DeFi by was like they used some neobank that's told them they would get 20% in DeFi, right? And it was like instead just dumping it into Anchor. I guess I bring that up from the perspective of like there was like this huge macro like DeFi summer. Everyone was like, oh, this is crazy. And then a ton of people tried a bunch of stuff. A lot of it failed, but hidden inside the stuff that failed was like a couple things that if that persisted from 2022 and 2023 that succeeded. And so like an example of that as a DeFi protocol that I would say that changes how you have to model the system in aggregate is Pendle. Because Pendle kind of started as kind of different protocol in like 2020 and then pivoted a little bit, but they kind of still focus on this like fixed versus variable interest rate swap, and they just survived long enough for the points program meta stuff to happen where like people suddenly did want to do this trade-off of like yield now for yield later. I think like there's this kind of thing in crypto where like almost every protocol is too early or too late. Like there's immaculate conception for very few protocols, you know, like Uniswap and probably Compound were in that, and even then in the case of both of them they're like not the top used protocols of their type anymore, right? So it's like maybe you don't want to be the immaculate conception first one. But the reason I bring this up is when you're modeling the multi-agent systems, you also have to treat the protocols themselves as agents, right? They're a particular type of agent that might have a constraint on its strategy, but it's an agent and it can interact with another protocol. And so I think the reason I bring up the Pendle case is like in DeFi lending, the PT assets from Pendle, the principal token assets, became a huge source of collateral. And modeling how the Pendle AMM interacted with the lending protocol was sort of like a new modality, right? It was like there's a lot of assumptions you made in a lending protocol about the oracle and about how liquidations work that are very different when you have this Pendle kind of setup where like the liquidity for that token is mainly in this one separate AMM. And so I think I view it more as like a bunch of regime shifts. Like there's like a new protocol, you model it, and then you look at the interaction with your existing system. And then you're like, oh, okay, I'm missing some agents, or I'm missing some change to something existing. Like, oh, the Oracle as an agent has to change. And then there's a lot of noise where there's like new things that people think are new, but are actually really just like amalgamations of old things. So they don't really change your system. And then there's like all of a sudden a new thing. So like, I think it's a little less kind of crazy like AI where all of those things happen at once, but there is this kind of like step function behavior, if that makes sense. Like that's kind of like it does have this like sequence of jumps. It's not like continuous, but it's also not like huge revolution all at once. And I think a lot of finance code is like my experience with like trading system code is like it often is like that, where it's like I trade a universe of a certain type of assets, and then like I add a new exchange or add a new set of assets, and like it does change like how I allocate capital across them, but I'm not blowing up my system. I'm not like rewriting from scratch in the same way, if that makes sense. Like there's incremental moves, but they're like large change incremental moves.
You mentioned Pendle, and I also think Pendle's like super interesting. Both as an example of like an agent that changes your mental model. I kind of have two like branching off questions for you there that I think are, at least to me, really interesting, and you probably have unique insight too, which is one, how much value is there in experimental protocols that are kind of like creating like net new vehicles on chain that may or may not be possible in like traditional finance? Like there probably are some things in crypto that are like net not possible to do in TradFi, and then Pendle, I believe you can actually do credits or interest swaps in traditional finance, but it was definitely like the first time I had seen it in crypto, and honestly the first time I had seen it anywhere. And then yeah, go for it.
Yeah, so like actually one thing I want to emphasize is that in TradFi, a lot of these credit products are not really like either very liquid or tradable without human manual intervention in some way. And like there's a lot more like legal contract related stuff around them. One very base reason is that you can't create and destroy TradFi assets as easily, whereas like a constructor and a destructor are very easy to call for programmatic assets. But the second thing is there's no like continuous time credit traded products in TradFi. Like it really is like I fix an interest rate, or I have some sequence of interest rates or waterfalls or whatever, and like credit didn't have like the quant finance revolution in full. Like it had like people using mathematical models to trade credit, but a lot of credit is like OTC and like very like bespoke. And I think the interesting thing about the on-chain DeFi products is like on day one they are like continuous time. Like every block there is like a set of transactions that can interact with it. And and the second thing is like credit can like share liquidity across products, across durations, across different asset types, in a way that in TradFi you can't like pool together these legal contracts, right? Like for this stuff, and it just has never really been able to be like liquidly traded in the same way. And so I think like to me that if I view kind of like trading as having like, you had like sort of the 1980s, late 1970s, early 80s options revolution, late 1980s like electronic trading, late 1990s like the beginning of sort of like higher frequency. Sorry, so I should also say, and then the mid 90s sort of like quantitative trading, but not necessarily high frequency, and then the early 2000s like the beginning of high frequency, and then by like the mid 2010s sort of like this blend of like cross asset and cross venue trading across assets. So like I think that crypto was sort of born at the right time for that, because like that's just inherent in crypto, but like TradFi people were just starting to do things like that. So if I look at that set of changes, the one thing is like all the assets that are involved in those were just like futures and equities, and I'm kind of like commodity futures there, but the thing that was like left behind was like credit, like CDSs, and a lot of these products around the financial crisis just like stopped being exchange traded, or just never traded liquidly enough, or like there's just like a lot of weird idiosyncrasies. But I think crypto is sort of the only place you're really trading credit continuously, and I think all the protocols in DeFi that have persisted have somehow found a way to take advantage of that in a way that's better than what you basically can't do in TradFi. Sorry, that was like a bit of a rant, but
No, it was super interesting. The other question I had was, you mentioned that Pendle kind of forced you to reevaluate the agency you're involved in the system of crypto, and like how crypto is like a multi-agent system compared to TradFi, where it's like the CME or some other largely singular agent that you're modeling. To some degree, Gauntlet exists to create a financial model of all of a chain or all of like an ecosystem. What differentiates a DeFi product that forces you to like update your model of the system versus it's just kind of business as usual?
yeah, it's a good question. So, we kind of mainly right now deal with like lending protocols, perpetuals protocols, and like spot incentive stuff. And I think those protocols, generally speaking, you can like find a lot of analogies between different ones. Like different ones will make different decisions on like how they isolate the assets, how they count certain things in margins, some things as not, different interest rate curves. But those are like different modules. Like if I'm thinking about this as like I write a system architecture diagram, or I write like your UML for all your class definitions or something, like these are things where it's just like I made a new instance of a templated class, right? It's not like a totally new thing. I think when it's a new thing is when it's like something where I have to like redefine the edges in this like graph, interaction graph. Like the moment that changes, then that means that there's something new. And so it's like I think of these things on the system level as like there's this graph of agent, state, and sort of interactions that those can have with one another. And anytime that graph changes qualitatively, like something that you could go in a circle on that graph, you suddenly can't anymore, or something added allows you to go in a loop, that means you've qualitatively changed the behavior of some agent, and so then you need to evaluate it. Now, I'm giving you a stylized, simple-sounding version where this graph exists and you can fit right, but the art of this is like reading someone who wrote some Solidity code or wrote some SVM code, and they're thinking of this just in the myopic mindset of like their product, right? And you have to be like, okay, like how do I take the code you wrote and like break it down into these components of like the types of users interacting with this particular function, their incentives, when would they use this function, what would happen if they were unable to use this function, and then from there try to figure out the architecture. But that translation is still kind of manual. Like I think like the interesting thing is I every time there's like a new LLM or a new open source model, I like constantly go and try to be like, how would you do this mapping? And I think sometimes you get really good answers, sometimes you don't. It feels like it's not a totally fully quantitative problem in the sense, or at least deterministic quantitative problem, in that there's many different ways you could interpret the different types of users. Because it's like, I don't know, oftentimes when you write code, at least my experience as an engineer was like you would think about the users, like clients of that code, right? Like who would call the functions. But until you're in crypto, you don't think about like the incentives of like why someone would call that function and if they will call it, and like what incentive, when are there no incentives to call the function, even though like if someone doesn't call it, the thing is over, right? And there's still a little bit of an art to that, because it's like I have to imagine who all the possible participants are, right? And like that's where I think there's a little, it's not totally like, it's not a formal verification problem, right? Because like I can't write you the set of conditions without being able to describe the set of possible users. But the set of possible users is like changing, and the introduction of a new protocol might change the set of users.
So that's really interesting. And like, a common criticism that gets levied against crypto is like, we're just recreating TradFi, except with a distributed database. And, you mentioned some examples of like where that's not the case, whether it's, continuous time derivatives, or like tradable interest rate products, things like that. Perpetual futures are probably another one, even though they were theoretically invented in 1992. You don't really see that much in TradFi. Given like all the scope that you've seen of DeFi development, I'd love to get your spidey sense of like, do you feel like there's way more room for financial innovation of like new types of products we've never seen before? Or is like, are we starting to reach the limit as DeFi matures of like the types of financial products new financial products that can be developed? Like, is everything from here on out is just going to be like, Aave, Compound, and GMX in a trench coat? Or is it like, do we see a world where like, continuously we're going to see more and more new things that have never been seen before?
I think like we will see new things. I think everyone's like expecting there to be like a constant rate of new things, but it's actually just jumpy. Like there's like going to be quiescent periods where there's like nothing that happens, and then all of a sudden there's a new protocol, or there's going to be like some old protocol that at the time it was made, the agents who needed to use it were just like unincentivized, so no one used it. And then later something new shows up that makes it suddenly useful. So like the best example again of this is Pendle, where like arguably they had most of the idea and the code for this like late 2020, early 2021, but like they just could never get any usage. And part of the reason for that was like this fixed rate versus variable rate trade-off needs, like in DeFi at that time, there was only variable rate loans. So like everything was variable rate. And the thing is, there was like no real demand for fixed rate loans, in the sense that like, sure, in centralized exchanges, tons of people like issued fixed rate loans to market participants. But for some reason in DeFi, I guess because it's like always on and like you can't like hit the stop button, no one wants to take the risk of like being locked into a rate that was like too high. And part of that just had to do with the products that were in DeFi, right? They were just like inherently variable rate, like over collateralized loans or staking stuff where like people like didn't kind of like there wasn't really a notion of fixed rate. But then, I think the whole restaking kind of bubble in late 23, early 21 introduced this whole, look, the points stuff had existed before, but for some reason that in particular had this crazy feedback loop with points where people who are already staking ETH could get free money in the sense by restaking in points. But there was a whole group of those people who wanted to lock in the gains up front. So it's like, I lock in my staked ETH into a restaking protocol. Restaking protocol promises me points. I don't know how the points convert to tokens. So that's the variable yield in the future. And some people were like, I would rather sell someone who wants to speculate on how much the Eigen token or EtherFi or whatever is going to be worth a lot of the upside to give me an extra 1% now. And a lot of that came from like Ethereum. People who leave their ETH and ETH staking for years are pretty conservative, and they want to lock in. Yeah, they just want to lock in the extra 50 basis points or 1% and sell the rest of the upside to someone else. And at that time, there was enough demand for that. So you had this fixed versus variable thing show up. It was like, and then all of a sudden Pendle had this huge boom, and then then people started doing things with like the Athena type of coins and stuff like that. So I guess like my point is like oftentimes it's like that type of product sort of exists in TradFi, and you could like really wedge your way into it, but it's more just about the demand. Like, is there like a market of these people who want to like interact in this way? And oftentimes DeFi has always surprised me over the years in the sense of like, yeah, maybe the terminal state of some protocols looks more TradFi like I look at AMMs or like Uniswap, and like the move towards like RFQs and things that are like more TradFi like has been clear. Like it does seem like that's the direction that a lot of on-chain trading is going. But at the same time, I just look at things like Pendle, and it's like, well, actually all they needed was like the right market conditions for it suddenly to be useful. And I think another important thing about DeFi versus centralized trading, which can be hard as from a software development standpoint, is that in TradFi, if people are willing to go to the cost of making a product, the product usually kind of like lasts forever. There's not really a clean way that things die. But in DeFi, it's very fast for like liquidity to disappear and like kill some market, right? Like clearly someone must have had to die when everyone went into restaking. I'm not even sure who it was in hindsight, but like there was like some protocol that probably like lost all of its assets and like wasn't able to like build a flywheel. And so this idea of like death by like liquidity migration, I think is also like a key thing. Death or birth, right? In the case of Pendle, then it suddenly grew. I think that innovation will keep happening, but it will be demand driven more than supply driven, if that makes sense.
It's a really interesting perspective because it kind of implies that there's like a zero sum amount of capital that wants to take those positions, and that is that kind of like how you feel, or do you think like there's more room for positive sum, and like not one protocol doesn't necessarily need to die for another one to succeed?
So I don't think it's like fully zero sum for sure. I think there's just like some protocols that like clearly like the lending protocols are like clearly not zero sum. I think the perpetuals protocols, it's not totally zero sum, but like there are times when it becomes zero sum. But I think staking is much more zero sum. There's just sort of like a fixed amount of yield and a fixed pile of capital, and like people trying to like maximize their earnings per share, or earnings per token basically. And I think DATs kind of show you that like there's like that is really zero sum, like the staking world. Pendle, however, is very much not zero sum, because it's like I'm taking fixed yield, and so I'm taking people who are risk averse, who like highly prefer not taking on this huge speculative risk, and then people who are like meme coin trader like entities where they like only want speculative risk, and I'm doing a risk transfer, and that's very positive sum in general usually when things like that work. And so but like that can only work if like there's demand on both sides, right? And I think like stuff in DeFi that ends up being positive sum has to have that type of behavior, whereas like a lot of the staking stuff, like especially people competing on staking stuff, it seems to be kind of making that go to zero.
So we're coming up to the end of the time, but wanted to ask you two questions that we always ask our podcast guests. First question, we work at Coinbase Developer Platform, where we provide tools and APIs for all types of businesses to come on chain. A lot of them are TradFi, a lot of them are enterprises that are just kind of getting their feet wet, but they see stablecoin boom and they want to be able to integrate that. From your perspective, it could be from the TradFi perspective or from the DeFi perspective, what is a piece of infrastructure, an API or a tool you think that CDP should build that would meet a demand in the market that is currently unmet?
Good question. I actually think right now there's this kind of huge race to like for wallets to like integrate yield sources as a way of monetization, whether it's like perps integrations, earn and vault integrations, etc. But there's not a very good like smart order router for that. And there's like a sense in which I'm saying this in a way it's like I'm not giving a spec. It's like kind of ill-defined, like how you define the.
No, this is great. This
here.
is alpha. This is really good, actually.
Like I feel like something that feels like a smart order, right? Because like clearly like institutional trading has that, but this kind of like wallet dispatch stuff doesn't, and like that's why you see this like aggregator on aggregator on aggregator layering in DeFi, like especially in the swap space where it's like very commoditized. Maybe there's a version for like that, and this might just unfortunately lead to that like XKCD where it's like there's 15 standards. I'm going to make one that unifies them all. Now there's 16 standards, right? Like
I thought we just got a vaulting standard. Do we need a vaults standard?
Well, I think the vault standard's fine. It's more actually just like the dispatch of like, like I want to dispatch onto base plus mainnet or like. And I think like for swaps, because they're like one-shot things, like I just dispatch and that's easier. But for perps and lending, like you have to hold a position over time. And so now you have to like do a lot more thinking about that. And I guess like if you're building an API for people who are already custodying at Coinbase or using Coinbase Web3 wallet, it feels like that's like a product they would maybe want. So.
It's a great idea. We'll definitely noodle with that. And last question for you. Who is a guest that you think we should have on CDPod? Could be on the podcast. Could be builder, could be investor, could be someone you think who has really unique or interesting ideas, but maybe folks haven't heard of yet.
I think you should get Vlad from Lighter. Because I think they took they took a long time to build their product in the sense of like they went through the idea maze and like tried a bunch of stuff and had this kind of pretty rigorous process for changing ideas. And then, I think at a time when this was sort of viewed as like the wrong thing to do in ZK software, like building custom circuits and then using somehow like going against the conventional with this is all new software stuff. So it's like, but conventional for like 2 years, like everyone's like, no, always use a VM. Don't write your own optimized circuits. And they did, and then made a product that was successful. So I think like that's kind of like it's like from a developer standpoint, I think it's kind of interesting to go through that whole thought process.
That's a great suggestion. We've definitely seen his name pop up in recent days. Awesome. Well, thank you so much for this. This was a very enlightening conversation on really gritty details of DeFi. Lots to ponder about. So thank you so much, Tarun, for coming on CDPod.
Definitely. Thanks for having me.
Lead the world's transition on chain by building with Coinbase Developer Platform. Visit us at cdp.coinbase.com. Follow us on X at Coinbase Dev, and be sure to leave us a review on your favorite podcast app.